Hello, and welcome back to the investment series by SCB Julius Baer, coming to you from Bangkok, Thailand. I'm Joe Caceres, Head of Investment Advisory and Solutions. Thank you for joining us. Today, we will learn more about the compelling investment opportunities available in private credit markets. As we are currently in the midst of the COVID-19 pandemic situation, with most of us working from home, including myself, on behalf of SCB Julius Baer, I would like to first wish all of your families the best and hope you stay safe. We look forward to this situation improving and seeing you once again face to face. Fixed income investing in today's market environment is becoming increasingly challenging. With continued low interest rates, many investors are hunting for yield and are taking on progressively more risk by increasing their allocations into high-yield bonds. Additionally, traditional fixed income portfolios are susceptible to potential future interest rate rises. Whilst over much of the last decade, falling interest rates have increased bond returns through positive mark-to-market effects, going forward, when interest rates do eventually rise, the same dynamic can work against bonds with fixed coupon payments. But there is an alternative area of the fixed income market that can provide enhanced downside protection relative to high-yield bonds, as well as floating rate returns, reducing interest rate risk in portfolios. At the same time, you can achieve even higher returns than are available in the high-yield bond market. And that alternative is private credit. But what is private credit? Private credit describes when private lenders step into the shoes of banks to negotiate and write bilateral loans to corporate borrowers. In the United States, bank lending has fallen over the last 15 years by nearly half, as banks have preferred to lend to mega cap companies in very large transactions, leaving mid-sized companies to seek alternative sources of financing. These companies comprise what is often referred to as the U.S. middle market. These businesses number in the hundreds of thousands. And if they were carved out of US GDP, they would be the third largest global economy. These are healthy companies and might be regional leaders in their industries. However, their financing needs are not large enough to attract the major banks. This gap has created an excellent opportunity for private lenders to step in, with private credit now comprising approximately 1/5 of the total addressable US credit market. What is perhaps most appealing about private credit is its superior risk-return dynamics when compared to much of the traditional bond market. On average, private credit produces higher returns than high-yield bonds, averaging annual yields well over 8%, compared with high-yield bonds that return less than 6% on average. At the same time, private credit benefits from far superior credit protection versus high-yield bonds, as these loans are predominantly senior secured, with first lien on assets and recourse to collateral. Being higher in the capital stack than traditional bonds means that private credit loans enjoy a much lower loss rate than high-yield bonds. In fact, over the last 15 years, when high-yield bonds averaged 1.7% losses per annum, private credit averaged losses of only 30 basis points, or 0.3% per annum over the same time period, thus making private credit over 5 times safer than high-yield bonds from the perspective of average historic loss rates. Additionally, I mentioned interest rate risk earlier. The added benefit of private credit is that these loans are written over floating rate benchmarks, meaning that in the event interest rates do rise, the loan coupons will simply increase as well, removing this interest rate risk from private credit portfolios. Whilst potentially appealing, private credit is not without risk. It is critical that these loans be originated and managed by highly sophisticated and experienced lenders, because if not structured properly and with adequate investor protection, the risk of losses rises tremendously. Additionally, unlike bonds, private credit is not a liquid asset class that can be bought and sold immediately in public markets. However, more recently, innovative and liquid private credit fund structures that do not require a lockup of 5 or 10 years have become available to investors. However, since each investor is unique and not all products are suitable for all clients, please speak to your SCB Julius Baer relationship manager or investment advisor to find out more and to explore whether this unique fixed income solution has a place in your portfolio. Thank you for joining me today. Stay safe, and we look forward to seeing you in our next investment series. Thank you, and Sawadee Kap.